What's up, everybody? We got Eric and Kirk. Welcome back to the Outlier podcast, and I'm stoked to have you on. Thank you for joining me. One of my audience members actually introduced me to you and what you were doing. So I had a chance to look through some of your background. I'm stoked to chat with you. Thanks for hanging out.
Awesome, man. I appreciate it. Thanks for being here.
Yeah, dude. So we were just talking a little bit about the coal building that you're in and kind of commenting the fact that here in California, we don't really have that kind of history. Is that part of the reason why you stay in the Northeast? Is that where your family's at? What keeps you there?
Yeah. Family took me here for sure. When we had our first kid, we moved back to Pennsylvania, where my wife is from. So
Okay.
I love it there. I mean, like the seasons are great. Like it's just a good place to live. Like my kids don't never really knew what traffic was until we went back to Virginia and visited family. So it was pretty fun.
Yeah, that's pretty rad. Well, it's also probably better for like their emotional development as human beings not to deal with traffic. So I feel like as soon as you find that, you unlock a different part of your brain that you might not even know is there. So
Yeah.
that's,
I mean, like
yeah.
we're Western PA, so like we do have a lot of like, I mean, Amish influence here is like pretty
Yeah.
big when it's outside of town. So they know that. But like when we go back and visit, family in Virginia, they're like that. Why are all these cars parked in the middle of the road? I'm like, that's traffic, son. Like
Yeah.
he's like, that's crazy. They just stay there all day. I'm like, most days. Yeah, most days.
Yeah. And believe it or not, they don't want to be there either.
Yeah, nobody wants to be there. So
That's the best part. Well, that's awesome, man. So I had a chance to do just a little bit of background research. I know that you did M&A at Deutsche Bank, and then you got into like REIT analysis, I guess. And talk to me a little bit about your entrance into finance. Based on what I was catching when I was watching that, it just seemed like you had an idea of what this thing was going to look like and what it was going to feel like, and then you did it, and then you're like, this is looking and feeling different than I expected. But obviously, I'm just taking a guess. I'm curious from your perspective.
yeah, I mean, I think that, like regard to Option Alpha, like specifically, like I've always been interested in finance, like just generally. I think it was nothing that like necessarily came super easy, but I knew I didn't want to do anything else. I've always been just fascinated by like finance and like why people make money or don't make money or how people like generationally like build wealth or not wealth. So I would say like as a collective, like I'm just like that's what I do. That's fun. Like I read finance books. Like I don't do anything else. If I watch documentaries, I try to watch finance documentaries or like market documentaries. So I'm a total junkie in that regard. And I think where like my path eventually led to options and then Option Alpha is just kind of more of like self-learning and discovery of like there has to be a better way to do this, like just watching, like my parents, they were in the same industry, like growing up. So like their income was very volatile in the sense that, like when it was good, it was good. And when it was bad because they were just both in the same industry. Right. And so I kind of like grew up trying to figure out like how do you hedge that? Like how do you get to more of a steady state, and how do you do that? And so I guess that's like the very like deep background around like options is like how can you try to do things in both directions and or even non-directional and try to do something. And so when it came to Option Alpha, it was just purely a blog at first. Like it was just a little Google blog spot, like a blogger thing. And then eventually came and, just kind of grew. People ask questions. I try to put things together. I feel like I like and enjoy teaching. I like learning and trying to like pass on some of that, or at least my perspective of it to some degree. And, over the last 10 plus years now, it's completely morphed in many different directions. But, I think where we're going, so to some degree, like we kind of know where we're going, but at the same time, it feels very new every day. I will tell you.
Yeah, that seems like one of the really cool things about what you're doing. Because similar to you, I actually, when did you start like actually trading in your personal capacity?
I mean, really, like before the 2008 crash, I started trading. I remember trading through the 2007, 2008 crash. But
Got it.
I mean, even before then, I think I think my very first stock certificate is up there. That's like a Nike stock I made my dad buy me as a custodian.
Yeah.
Um, I still have it. I don't even know if they would accept it now. They probably don't even accept that stuff anymore. But I've always like kind of enjoyed that. But really, kind of like right before the 2007, 2008, that's when I really started to get more of an interest in doing it. So.
Which is really interesting because I started trading in 2007 myself when I was in high school. So it just kind of was the way you're talking about it. It made me think a little bit about, it seems like some of the background and the progression that you found as you were talking about it really resonated with me. So what led you specifically to options as compared to the Nike stock that you started with. Obviously, you found your way into derivatives. And I remember back then, it's not like there was a ton of stuff out there on derivatives. I ended up like stumbling across it, literally reading a book in a library, pretty
Yeah.
old school, but that's exactly how I found derivatives. How did you come across them?
I think that I kind of stumbled into them. Like I did, like we used to calculate Black-Scholes in college, like by longhand, like doing that. And I kind of got an interest in doing it that way and found out, a little bit more about it as I kind of like progressed and like grew and stuff like that. But I think for me, it really came down to like figuring out like that there was this completely other way to invest that was not just omnidirectional, like one directional, like you buy it and it goes up and it goes up, right? And we many people have probably heard of short selling, right? When they get started and they're like, oh, well, you can sell it and then it goes down. But just like the capital usage just seemed like a drag, like I read all the books about Buffett and Munger and all these guys. I'm like, I just don't even know if I had the wherewithal to like do that for a long term. Like, could I really pick and choose, different companies? I mean, when I was a REIT analyst, like one thing I always remember, and I tell people this a lot of times, like we had a company that announced earnings, and I mean, REITs are pretty boring. I mean, like it's a leveraged corporate bond essentially that trades, right? So like REITs are insanely boring. Like you know exactly what it is. You have all the lease schedules, like all the debts lined up. Like it's almost so predictable, it's scary, right?
Mhm.
But then the company announced had great earnings, whatever, and the stock went down. And it's like, what? Like, come on. Like,
Right.
so now like, even if you get it all right, even if you find something that you absolutely know what the schedule of payments and cash flow is going to be, and you know what the operating is, but the whole thing, like it still doesn't matter, like because the market has their own opinions and their perspectives, and then you got all these other things that just get thrown into the mix. So at that, like I would say like around that time is when I started to figure out like, okay, like there has to be something better. And so for me, options not only just ridiculously more capital efficient, but just from this the sense of like being able to very quickly change and move directionally into different strategies, I always found insanely fascinating. Like if something wasn't working, could I, re-engineer the strategy? Could I roll it? Could I hedge it? Could I do something? Like that, no pun intended, but there's just a lot of choice and options in doing that. Like if you can figure out something where you can move that fast, then I feel like that's the place that I need to be. Like if you even look at like real estate, you can't move that fast. I mean, you really can't. Like closings take 30, 45, 60 days, right? Sometimes now 90 days, right? And you can update and renovate a property, but like that's time and capital. I mean, like, so there's a little bit of that component to it, but in options, like I can be out in an entire industry in 5 seconds. I could be completely short and completely long two different industries in the morning and the afternoon, right? And I could be neutral something else. And like that speed and like the ability to change direction, and then also I like have the ability to comprise a strategy based on the outcome that I think or maybe think is working. I think it has always fascinated me. So
I completely resonate with you. And one of my favorite books is actually right there. It's Options as a Strategic Investment by Lawrence McMillan. You obviously must have heard of it at some point. It's a giant textbook, like really foundational concepts. I think it's nothing like super crazy, but one of the things when I was first reading it that really stuck out to me is the concept of like a strategic investment, which
mhm.
is kind of what you're highlighting, is that you have the ability to trade something long. You have something that you're trading to the upside, but have credit you receive up front, limited profit potential, but higher potential for profit. Those kinds of variabilities, I think, to your point, are exactly what make options so fascinating, and probably one of the most adjustable tools available for us to trade different dispositions. However, I imagine, and I went through this myself, when you're a newer trader, all of those choices also become your downfall.
Yeah.
Do you pick this one? Do you pick that one? And then if you pick this one and you use it for 3 months and it worked well, but then you find out, oh, it actually doesn't work that well, you should pick that one. Like that world of choice can actually become difficult. So when you think about your journey through options, how did you navigate that world of choice? Because you can set them up to be literally whatever you want. And infinite variables can be overwhelming. So what's your approach there?
Yeah, totally. I mean, so I'm definitely a fan of like, I don't know if you are too, but like I'm a super crazy fanatic now about like all the F1 racing since like all the Formula One Drive to Survive has come up. Like I love it now. Like, and I've always liked cars and racing. So that's not anything different, but like F1 specifically. But if you look at like an F1 steering wheel, right, which is like a insanely fast, agile car, and use that as a proxy for options, right? That steering wheel has so many buttons on it and so many modes that those drivers go through even in a single lap. I mean, they're changing brake balance and they're changing, like gear and battery pack and, energy efficiency while driving 200 miles an hour, right? So if you take that, did you pull up one of those?
I
Yeah,
did.
it's like, look at all those modes that they're on. And if you watch them, which I like, I watch, like I do like the cockpit view sometimes, like, and I like watching them. I mean, they're changing dials all the time. They're shifting
Hmm.
gears, whatever. So you think like options as a metaphor, and I'm a sucker for a good metaphor. So like you think options is a good metaphor for like this insanely fast, agile machine that you have at your disposal. And you can take it anywhere and it can zig and zag and go fast and slow and whatever. But then there's all these dials that you have to press. And the reality is that it is insanely complicated to do. I think though that many people press everything. I think that there's a natural inclination to touch every dial, to mess with everything, to want to understand the intricacies of how everything works. And I get that. But the reality is that many times you just got to get into a car and hit the gas and change the steering wheel and brake. And like there's a couple things that probably move the needle more than the combined essence of all the other things. And so I think like over time, and I feel like I'm still developing this. So I don't think that I've figured it out totally yet, but I think that I've learned that there are a couple things that kind of not save you, but just like they're the really important big rocks, like position sizing, staying neutral, diversifying tickers. Like you get most of that right, and like selling premium, like you get those big rocks right, like you can make some mistakes along the way and be okay. Like you can come out unscathed. But if you go in there and you feel like, you need to have, a scenario for every half scenario that happens, or modify something for every off that, happens at the Fed, like that, then like that's going to be a complicated road because you're going to want to always adjust and like recalibrate for every little thing. Like recently, I wouldn't say not recently, fairly recently, got into something with somebody who said like I was doing a workshop and I scheduled the workshop specifically at 2:30 when the Fed was speaking.
Hmm.
And a bunch of people got super mad and they're like, why did you schedule this at 2:30? Don't you know the Fed is speaking? And I was like, of course I know the Fed is speaking because I don't want you paying attention to the Fed. Like I would rather maybe you come to a workshop, learn how like options work or how different strategies work, whatever. And I got into this little argument with the guy and I said, like, why don't you like if your strategy is so dependent on what one person is saying, like how can that be a sustainable thing? Like if you need to tweak your strategy, like that moment that the market, that the Fed speaks or Powell speaks or whatever, like, like how brittle is that strategy? And so I think in trading, it's finding the things that actually move the needle, like actually push the car down the road, and then figuring out to ignore all the other stuff or make it resilient enough to trade through that. Like you can't possibly account for everything, right? And so it's figuring out like what are the most important things that kind of mesh with my style, my profile as a trader, and what can I completely ignore because I can't figure out everything. So
Yeah, I love that. It reminds me of a saying I use all the time. It's from Leonardo da Vinci, but it's simplicity is the ultimate form of sophistication.
true.
And I've really found a similar path. It sounds like we probably have slightly different trading styles just from what you were mentioning, but regardless, I think one of the main things that we probably deeply align on is a simpler, more robust thesis and way of executing against that thesis. And also the car metaphor was really fantastic. I run a car club out here. I love cars.
Nice.
I've been building cars since I was a kid. That's actually a painting my mother-in-law did of a C7 that's sitting in the garage that I built. And yeah, so anyways, love cars. So yeah,
Yes, well, of course as
yeah,
well.
we
That's
have
a perfect 4 hour conversation I could have too. So
yeah, dude. We have a bunch of really cool places out here. So we have Thermal, where there's a pretty well known track. BMW M School is there. So I had a chance to go do that. That was super cool. But to your point on finding the specific levers that give you the Pareto principle, right? 80% of the solution on 20% of the focus. That's I definitely found that with driving and in trading as well.
Yeah.
When you think about the way you started trading and then the way that that's evolved over time, walk me through that.
I think it even like that evolution has, in my mind, it has been like a slow progression. And then in the last, like, let's say year and a half, it's been like a ridiculously, I would say like in my mind, and this may not be for other people looking at it objectively from the outside, but it is completely changed in the last year and a half. And I would say because many people and many traders, like we don't know what we're doing. Like we come into the market every day, and the analogy I use, like you come in like a cowboy, like walking into a saloon, and you're just shooting up the place. Like you really don't have a plan. You kind of like are gunslinging from the hip, and you hope you hit something, and that's 90% of people walking into the market every day. And like, so if you sit down at the, your trading desk or whatever you have, and you kind of fire up the markets, whatever routine you go through, you're looking for and hunting for a trade, right?
Mhm.
There's probably very rare breed of people who knew exactly what they were going to do, went there, made the trade, and then like bounced, right? And got out. And so I'd say that for the most part, that was the initial evolution, was just like hunting for trades, being a hunter and gatherer, trying to figure out, what we were doing and how it was working, and trying to do some math and calculations and analysis, right? But at some point it gets repetitive and boring, and you're just like, I forget, I kind of know what a good trade looks like. And so that was probably my progression for a long time, is kind of like the hunter gatherer type trader, where I did have an idea of like, I wanted to trade these symbols. I generally wanted to be pretty active. I generally wanted to stay pretty neutral, but there wasn't much mechanics behind that, right? Other than like the routine and the habits that I had formed. And I feel like I had formed okay habits, but of course, like I would slip all the time, like, I forgot to make that trade, or gosh, I should have, adjusted that, or I should have taken profits, or whatever the case is. And so now where I've gotten myself to is to much more of, I mean, like obviously I use our own software to do this, right? And purely do this. But like now it's much more of a mechanical thing, where I'm really having my bots look at and perform analysis for me. And then like I'm setting the criteria to say, like, okay, of all the things that are out there, these are the things that I'm willing to accept. And if you find one of those, then like let's try to go after it, right? So it's much more hands off, in the sense that I'm not in there digging for trades every day. I'm not in there, like looking through symbols and going through option chains. Like I've set my criteria, and then I have to have enough patience and, understanding to let the bot go through those and try to adjust for market scenarios. And, oh, that's different. I didn't know that, it was going to find that. So let me adjust this and tweak this. And it kind of runs a little bit different. I think that where I go to nowadays is really doing a lot more of the, and when I say I don't mean that I am physically doing this, but relying on technology to do the math and the calculations and the analysis for me. And then I'm just the gatekeeper to say, yes, that's something acceptable that I will take on as a trade. Does that make sense?
Yeah. Yeah, it makes a ton of sense. So, talk to me about what your return profile looked like pre automation, or it sounds like general automation, but not like full execution. It sounds like there's still at least some like human intervention on your side, like, yes, take this, no, don't take that.
Well, you could.
But
I still love to trade, so I'll go in and like find trade ideas and just like
right.
kind of onesie twosie pick trades. But for the most part, like the trades that my account is making is purely through bots. So like
Okay.
some of
So,
the some of the bots that I run, like it will make it'll make all the trades, like in,
okay.
out, adjust if there needs to be adjust, whatever. Like it's totally hands off. And so I look at that and I say, okay, like how does that work out? Like it just depends like on how many trades it could possibly find. Like for example, like I run a bot that's trying to trade TLT. TLT has been a bear to trade because like the numbers just don't add up there. Like that, it just hasn't been able to find a trade. So that bot's been running for 7.5 months and has found two positions, right? Now, maybe that means my criteria is too strict. Maybe it's not. I don't know. But like it's found positions. It just hasn't found a lot of positions, right? And so I look at that differently, I guess, if that makes sense.
Yeah. Yeah. So then when you look at your trading performance pre and post automation slash partial automation, how does it compare? How did you do before? And then how do you do once you started switching over to this?
Yeah. I think it's about the same in the sense that like I think I generally stay in the same range where, I'll make a little bit, I'll lose a little bit, whatever the case is. I think what I've found that is different because like the bots right now for me are about a year and a half, 2 years into it. And some of them have been running sooner, some of them have been running longer. Some like one bot I run has 49 trades, another one has, 30 trades, right? So I don't know if there's enough math yet for the bots to say like, oh, okay, these are, going to be absolute home runs or not. Like they're still maybe sort of in like a testing mode of like, sequence of returns. But I think that the difference for me is I know I'm getting better trades out of them. And I know that I don't have to watch the markets and like rely on myself to do that. Like I can trade through like one bot that I've had running since at least the second version of it, because I moved it from a different brokerage, has been running for a year and a half. And like I've traded through it's traded through every Fed, every whatever, every discussion. Like I don't have to worry about it, if that makes sense. So I think the mentality towards the markets has changed. I feel like I don't check and like anxiously await every movement, every pre-market earnings, every pre-market, thing. Like that mentality change has been huge because like it's super stressful to try and manage a bunch of positions and then like recalibrate everything when the markets change. I think that that's insanely stressful. So
Got it. So it sounds like it performs around the same, but it is way less high touch and something that you don't have to hover on, that kind of
yeah.
thing.
Yeah, I mean, it is what you want it to be ultimately. I mean, like a lot of people love to do high touch with it. Like some people run 250 bots. Like I don't do that. That seems like a nightmare. Like that's overkill. But I think for me, because I'm super conservative in running them, like it's about what I expected. It's just now I don't have to do it.
Yeah, yeah, that makes a lot of sense. So when you talk about the process of automation, one of the questions I have about that is how do you maintain then your closeness to the markets if you're not necessarily combing through the options chains? Is it something that you'll still do periodically just to take a look at things? The reason why I ask is, at least from a discretionary trader perspective, which is, primarily what I do, a lot of what I pick up when I'm conducting research doesn't always stem from something I'm directly looking for, but it's a peripheral data point that I end up seeing. So is that
Mhm.
something that you either automate and then kind of look at readouts that shows you those kinds of things, or are you still perusing through yourself to, see what you find periodically?
Yeah, I mean, I think there's like a level of keeping your head above water and like situational awareness. So, like if you play football, if you're like a quarterback, like you're going to be looking at receivers, right? But like you're not looking at the lineman that's about to tackle you, right? But like you kind of know he's there and you can kind of feel him off to the side. Like he's moved around the backside, but your eyes aren't looking at that. So there's a little bit of like situational awareness that you should develop as an investor where an investor trader where like if you're trading and you're actively trading, then you should kind of know what's going on. And I think it also has to do a little bit with like the duration of trades, right? So a lot of people, if they're trading like zero DTE, like every freaking day counts. Like you should know exactly what the hell's going on every day because if you're zero DTEs today, like you should know if the Fed's speaking at the end of the day. Like that's going to change how you trade today, right? But if your duration is say 35, 45, 60 days out, well, then today shouldn't matter that much, right? Like it shouldn't matter. So you should have an awareness of it. Like, did the Fed, like, are we going to a new interest rate environment? Okay, that's something important to know. But if it's something that's non-existent, you shouldn't really pay attention to it or just completely ignore it. I think though that what I found even in doing that is like I find that you generally see just the quality of trades come through where it's like you see like, oh, I used to get this much premium, I used to get this much premium. Now call spreads are, pricing a lot better than put spreads. So like that's something that you start to see, and maybe the bots are opening a couple more call spreads. But generally speaking, I'm much more numbers based with trades. Like I tell my bots exactly what I want to get out of them, how they should make trades, like what tickers they should trade. So I want to run a more mechanical process that's long term that tries to avoid all of the noise. But that's where like if I make a trade and try to push in a trade, like if I see something, I'll make a trade. I'll be like, okay, I want to trade something in that ticker symbol. So let me go find, something to trade in that ticker symbol and just do it from a different angle, I guess, versus just like randomly choosing. Like I think a lot of people, what they do honestly is they pull up a option chain and they go, oh, I don't know what the hell. Like somebody said, Tom said 45 days to expiration. So I'm going to do 45 days to expiration. So-and-so said 50 delta or 15 delta. So I'm going to do a 15 delta. But like, is that the best trade right now? Like there's no way to know unless you're analyzing all the possible positions. And like, that's where we as humans and like we are flawed. Like we can't possibly do that. Like our better, more strategic use is at a higher level to say, no, these are the things that we will specifically avoid, and these are the things that we will do. And if you find something, then you can trade it. But like digging down into that math and those calculations, and as fast as the market's moving, like it's just not possible to find, I think, the most optimal trades in many cases.
Interesting.
I don't know if that
Now,
makes sense.
yeah. No, I'm following you. Now, I was looking at your profile on Option Alpha, and you look fantastic, by the way. But it obviously does beg the question when you see somebody holding a coffee cup. Looks like Starbucks. Is this a S-Bucks
It could
coffee?
have been. Yeah, I think it could have been for that photo. Yeah.
Okay. And then what kind of coffee would we be consuming? Is it what's your flavor?
Just regular vanilla. Can't do
Oh,
black.
nice. I
Yeah.
dig that. And then I also saw old cars. So that's actually how I started in automotives. I used to restore old cars with my uncle. So it was
Mhm.
mostly 56, 57 Chevrolet Bel Air, Nomad, a
Oh,
64
the best.
Stingray. Yeah,
Like a
64 Stingray was one of the first.
nomads, so cool. Yep.
It's actually why I have a C7 Stingray that's white, is because one of the first cars I worked on was a white 64 Stingray with my uncle. But talk to me about your flavor in old cars.
So my dad was a master mechanic for Nissan for a long time.
Oh,
And
cool.
then when he left Nissan, he opened up his own shop. And that was when I was in elementary school. So I remember getting off the bus, they would drop us off at his shop. And he didn't have it too long, but he did have this like shop where he would help like, people repair their cars and whatever. But we would always fix cars. Like, so he's got an 86 Grand National, he's got a 68 RSSS drag car that we, fixed up and we used to race together. Like, so we would always do that. We put together two 350ZXs, like one that had crashed in the front and one that had crashed in the back, and put that together. And that would have been my high school car until we lent it to a friend who wrapped it around a pole. But
No.
yeah, it was insane. It was insane. It was ridiculous. It was so ugly. It was red with gold wheels, but it had T-tops. It was like at
It's
the time.
perfect. That's
Yeah,
literally perfect.
it was a cool one. So, but it was 86 350ZX. But so like I really truly enjoy all cars. I would love to build a car. I tell my kids all the time, like at some point, dad is going to build a car, and I want you guys to kind of like help with that process because that's what we did. Like we like swapped engines, like
Yep.
like all the time. Like there were just cars kind of coming and going in my house with my dad, just trying to like renovate them, and he would keep some and sell some and whatever. So. I'm partial to like the muscle car area, but I like the odd stuff like the AMCs and the Javelins and like
Hmm.
some of those things that are just like not run of the mill stuff all the
Yeah.
time. Yeah.
Dude, that's awesome. Yeah, I actually installed a lift in my house so that I could work
No,
on that I can work on the
no
Corvette.
jealous.
Dude,
So
yeah. I know. I literally I was thinking, man, like how bougie have I become that I'm like, instead of using jack stands and hoping that this thing doesn't crush me, that I'm now using a lift. But I tell you what, man, one of the best
neck
investments you
saver.
could, dude.
It's a neck saver because if you get
It,
under a car or do anything, like I feel
yes.
like is like dead.
That's so funny. Yeah. And then it's also really cool that you like some of the odds and ends. I ended up grabbing a McLaren 570S for that exact reason, because I never had a mid-engine car before. They look weird. And all of my build cars have been manuals, and I've never really had a automatic or paddle shift. And I wanted to mess with that. And it's interesting because the technology, obviously, in the newer cars is just wild. So when you're thinking about
That,
building a
that new Corvette when they just did
C8,
like the engine car, like
yep, the
I got a
C8.
chance to drive one of those. That like traveling thing that does like the drive. like they go around the racetracks and you can like, drive like 5 cars. So my wife got that for me a couple years ago. I drove 5 cars. I drove one of those Corvettes, and it was insane because it has that dual clutch where
Yes.
like it's right. You don't even feel it, and
Yep.
it's bananas. And yeah, I love. So like those are all equally as cool. I just get scared of any of those things because I'm like, I can't fix that at all. But like I can do a carburetor and like I
Dude,
can, you know, like
dude,
I,
the first thing I did when I got the McLaren was take it all apart. I took pictures too, just because I think it's novel to buy a supercar and then literally just dismantle the whole thing. But to your point, I actually have been blown away with how straightforward a lot of the McLaren is. It actually is a much more accessible engine bay and transmission than my Corvette does, which is
uh,
fascinating. Yeah,
yeah.
absolutely fascinating. It's not what I was expecting. And it's also not what I saw on the C8s. The C8s is a different beast, man. Like that, they packed in everything. So,
You want to change the belt, you got to rip off the rear end.
dude, yes, that becomes a massive project. Honestly, even
Never,
in this,
never driven a McLaren, but I've heard that they're pretty fun. So
they're really cool. They have electronic steering, which is weird at first. When you're driving one of those, it's obviously, a completely different feedback mechanism. So it feels like you're feeling everything. So the first couple times you drive them, it seems like you almost need an alignment or something, that the steering wheel is so active, but it's literally just the car picking up everything on the road. And then when you take it to a track, all of a sudden it's not picking up all this random road noise, and it's fantastic.
that's
But
awesome.
yeah, it's a blast.
That's awesome.
So I got a couple questions from folks that I'm going to relate to you. One of them is from a dude named Tyler from X or Twitter or whatever the fuck I'm supposed to call it. I don't know. Sorry, Daddy Elon. Just let me know. And I think I know your answer to this already based on our conversation so far, but it's a good question. So they're asking, what's your perspective on a mechanical income trading style versus opportunistic discretionary trading? Obviously different things, but I thought interesting question for you.
Yeah, I think that I think you should have both, right? Like
Mm.
I think there's a universe where both work out really well. I think the opportunistic discretionary thing is super tough because I feel like that's the hunter gatherer like mentality. I mean, like even just look at what happened like last week, right? Like so Roy and Kitty or whatever came back, GME was pumping, like everyone's like, this is our opportunity and piled into it. Now it's crashed again. I don't know. Maybe it'll come back up. But like unless you're there waiting for that and you don't even know when it's going to happen or how far it's going to move or whatever, then you're kind of left holding the bag all the time. Like there has to be some component that needs to be more strategic, right? And if you want to do the opportunistic, like opportunity fund, like keep some cash on hand for things that come up, certainly you should do that. Like even the greatest, investors of all time, like Buffett keeps a ridiculous amount of cash on hand, mostly for insurance, but like he keeps cash on hand for the fact that like something could come up that he would want to, like purchase and acquire. And so I think you should have both. I think that most of it should be like strategic mechanical trading that like just takes advantage of things that you want to trade. Otherwise, it seems like a lot of chasing your tail. If that, yeah.
Yeah, I follow. I also agree with you. The way that I think about trading stuff like that is I have kind of two buckets. The way I split out my portfolio, I have what I call a core allocation and a speculative allocation. So
Yep.
it actually falls very similar in line to what you're saying. I also heard Warren Buffett's latest statement and their annual shareholders meeting, which is fascinating because somebody commented on literally the billions of dollars of cash they have. And at one point, he was just like, he had the best response. He's like, I don't think anybody knows what to do with $1 billion, like to invest. He's like, do you know? He's like, because we don't. He's like, we're just finding opportunities as they
Like he
come up.
doesn't know. Yeah, yeah, of course. And if he did like, I mean, he's keeping a lot of cash on hand for insurance anyway for float. But like, I don't know, like what would you? Yeah, like there has to be something to it. So
And a big part of that he brings up is kind of what a lot of retail traders I think take for granted. And to be clear, retail traders, we don't have many advantages, but one of them is the fact that we are small and we can just enter and exit things essentially at will, which you mentioned before. Whereas one of his comments was like, where do
This
you
is a
go
problem.
buy several $billion of something to make it a position that's meaningful enough for them to even bother putting it on? And you essentially have liquidity where you're not bidding yourself up the whole time.
Yeah, size is an issue for sure. I think that, you know, like in the same vein, though, I think that people can fall into the trap of thinking they should trade all the garbage and junk and they get railed by these wide spreads. And it's like, why are you trading that? Like, is that the core position? Like, because you're doing 50% in some no name ticker with a dollar wide spread, like you're going to get taken to the shed, you know, like I don't know, there's something to be said, yes, about like keeping it small, but at the same time, like you should probably be playing in the pools that are pretty liquid anyway. So,
I think exactly to your point there too, playing specifically in the pools that are relative to your size. And
mhm.
I think that's another thing that I find with retail traders. And I'm curious what you're seeing from your side because you interact with them from a different perspective than I do. Where when I talk to traders about cost, it seems like the vast majority don't actually understand the friction involved with
Mhm.
trading. And a lot of people will be like, oh, well, my broker has no commissions. And it's like, okay, well, that's what you see on the front end. But you understand, right? That on the back end, there is where you're actually getting filled at, and there's where your order's getting routed to, those kinds of things. And I find traders don't really grasp the concept of the friction involved. What's your experience with your audience, which obviously I imagine using bots, that's got to be a big part of trading considerations, is to make sure that still it makes sense after friction.
Yeah, I think that, you know, like, thank God commissions have come down from where they were, you know,
Like
like,
$5.
yeah, it was ridiculous. And, you know, the funny part is like now, and I did this in a presentation in Florida recently, where it's like, we're going to get to a place where like, and it's even happening now, like one broker charges for phones. Like if you call and make a trade, like it actually costs you a lot of money, you know? And
Mhm.
it's like, wait, like what? That's customer service, but like they charge you money for it. So like I think commissions are going to continue to compress, of course. And I think you see a lot of brokers who are at zero or near zero. Now they all still make money on payment for order flow on the back
Yep.
end, you know, like every one of them, right? Or let's say 99% of the orders are payment for order flow that are filtered through Citadel or whoever, right? And so I know that people know that that happens, but because they don't see it, right?
Right.
They don't think it happens, but it happens. And so that's where I say, like, if you're trading and you're trading in a 50-cent wide market, like, so what? You get free commissions. Like the
Right.
markets are just too wide, you know, like you might as well be giving that up anyway, because that's what you're doing, like in and out. And so I think that the free
Question.
commissions is good. Yeah, go ahead.
Sorry, just a question on that specifically, because I, like you, I actually really enjoy teaching people
Mhm.
and I just find it really fulfilling. But this is one of those topics that I struggle to get people to see
Yeah.
because I think even if we frame it like that, it still doesn't hit home. And I don't know if you have a way to like to help people see the actual impact that that has on a system. I haven't found a good one. That's why I'm asking, because I've tried to have this conversation with people on Reddit and different pages. And obviously, Reddit's always a blast because that is the Wild West. But a lot of people just struggle to see this idea of, even bid ask spread. They don't understand that that is essentially a cost of them doing business. I'm just curious, have you found a successful way to get this across to people?
Yeah, one way we're trying right now, because I agree, and like this has always been a thing that like is hard to quantify anyway, because you can see the bid ask spread, you can filter by bid
Yep.
ask spread, you know things are tight, but then like quantifying that, and so one
Mhm.
way that we have tried to do it recently, this is actually like in the last 2.5 weeks, we published this now,
Mm.
like as part of our options liquidity ranking, we calculate like a scalp on each contract, and it
Oh,
basically is
that's
taking
awesome.
like the bid ask spread and slippage of the stock times 100, shares, whatever. And it tries to quantify it to like a number of like how much a potential market maker is scalping on the spread, for
Right.
like for each of those contracts. So if you look at like QQQ, the scalp might be like $1.36. And then you look at something like Costco, let me just pull up Costco, and Costco's scalp on each contract is, and then again, this is just the way we're calculating it. So it may not be
Sure.
exactly right, obviously, but like the scalp on Costco is $5.45.
Hell
So
yeah,
like
brother.
that's how much you're losing just trading a contract
Right.
of cost. Now, if you can make that up on the back end, I mean, by all means, like, knock it out of the park. But like a lot of people have really enjoyed that because they kind of filter and rank by that now. And I think that we're trying to like bring that more to like a ground zero, like this is the dollar amount that it's costing you to trade this, just even look at it, it's $5 to get in, and I think if people understood that, their decisions would be better. Now, on the complete opposite end, to tell you the truth, right? Like you do get these people that are hardliners that are like, I'm only trading SPY and only SPY and only QQQ and whatever. It's
Sure.
like, well, that's not good either. Like that's like
Yeah.
drinking water all day and calling yourself healthy. Like it's just not like it's not going to work, So
Yeah. Yeah. What I try to, at least one, I love that tool and that concept because I also think, and you guys are super fucking smart, so I'm sure you're thinking about this. But from a consumer standpoint, if you put it in the sense of like, this is what the market maker is making, one, it creates kind of this common enemy thing, which I know that's not necessarily what you're trying to do, but it personalizes where the money is going. Because a lot of people, I just think they don't grasp the movement of that capital, which is really, I think, a great way to frame it. But the way I try to encourage, and I don't know if there's anything you guys could ever integrate into your tools, but I try to integrate for at least my audience in the way that I look at this stuff is the spread as a percentage of the price. It just puts it on a relative basis, right? So if you have something that has a good spread, SPY, fine, SPY, cool. What is the percent spread on that individual option that you're looking at relative to the price, and carry that over to other things? Because that's what I do in a personal capacity. But anyways, just another idea for you guys.
Yeah, and we do that. And the other thing that
Oh,
we
cool.
try to do also is we try to do like a fill percentage. Like how far do you have to move through the spread to actually get a fill? Like are you like filled at 50-50? Like is it 50% of the spread? So like it's mostly filled at midpoint, or do you have to move 75% of the way through the spread? So now it's like, okay, like double quantifying it, like the spread super wide plus like the average fill. And because we can track and see all the fills, right? Like we can run these numbers and metrics on all these tickers and see like, oh, these tickers, like they fill most often at mid price, whereas these tickers, they fill usually towards the further extremes,
Right.
right? And then you can say, okay, like now I know, like maybe I should be focusing, or at least just know, like have an
Mhm.
awareness. Yeah. So
Yeah. Yeah, that's absolutely awesome. Well, another thing, and I'm actually curious what you think about this. You're probably closer to these topics than I am, but I'm still trying to figure out why SPX moves at a nickel because I trade SPX all the time. And that is insanely frustrating because I understood the origin of it, but I feel like that would be nice to change.
and listen, we have a petition going to try and change it. I don't
Really?
think changed.
Oh,
Yeah, seriously. We've had a petition going for quite some time now. It's the only product that really does that, like on a mass scale, right? There's other
yep.
products that do it, but we've literally had conversations with the guys over there at SIBO, and like we know like that they're just like, look, it is what it is, and we've done that, and they're kind of like, we wish we could change it too, and like go
Oh,
back and
I'm
like
sure you
it's
guys
so
wish.
it's so integrated now at that point that yeah, I just don't I mean, I understand why they do it. It's just like a
Of course.
sizing thing, but
Yeah.
yeah, it's a pain in the ass, honestly.
Yeah.
So
That
yeah.
that one's yeah, that really gets the old goat. Really pisses me off. I don't like that one.
Yeah, yeah, us too. I mean, like we don't even support SPX because of it. Like it's the only ticker that would literally break all of our algorithms that are built on like penny wide increments and penny wide orders. So
I see. Yeah. That's actually another question from I think this one was from Reddit, but they were asking if you guys are going to do a mobile app.
yes, we are trying to hire a mobile app developer. We almost had an acquisition hire, and then they backed out at the last moment. But yeah, we are like balls to the wall trying to figure out how to do a mobile app. I think that it'll be interesting because a lot of people I think will still want to build bots purely on desktop, right? So I think it will be something that the mobile app is going to be more of like a management, database, right? Where
Mhm.
you can manage, turn off, turn on, of course, enter positions and do trade ideas, but the actual mechanics of building out bots and doing the decision trees and the flow of like the if this then that etc, like that will probably still be on desktop because I just don't think you could fit it intelligently into a mobile app. So but yeah, we're trying to go down that path.
Yeah, it's interesting too to think about like the migration of that technology. I am just so ignorant with all of it. but I have a buddy that works on this stuff, and he explains a lot of the migration of things from desktop interfaces to mobile
So
app.
different. So
Yes.
different.
Yeah. Which is really because I think a lot of people they look at it as, oh, well, you already have it, just move it over. And it's kind
Yeah.
of like, no, you literally have to like essentially build it again. You get to leverage a lot of it, but
Yeah.
yeah.
Yeah. Like we try to do a lot of mobile first things on like the website anyway, but like it really needs a true mobile app that like is mobile native. So yeah.
Yeah. Well, cool. Thanks for at least a little bit of details on that.
Yeah.
You mentioned a couple times that I want to key into. We agree on a lot of things, so I want to dive into something I think we don't agree on. Um, it sounds like you mentioned like a neutral focus in trading. Why neutral for you?
Yeah. So I think there's this, let me see if I could pull it up. I don't even know. I don't want to like go through like the presentation and share it, but like let me try to describe it because I think it might help out. But if you got into a position and let's say you were bullish on, like let's say you were bullish on a stock, right? And you sold a short put spread. And we go under the assumption that like this is not your only position, right? Like you maybe want to have a couple positions, call it 3, 4 positions, whatever it is. I believe that you should try to keep a new, like be working towards a neutral stance. And that's not because I think all your positions should be neutral, because I don't. But I think what you should be working towards is like a neutral, non-directional stance. Because if you purely make money and like your strategies are set up to only make money in one direction, that makes it increasingly harder to make money in various market conditions. So like what I try to do personally is like I don't care where the market goes because I will let my bots adjust for if the market goes up, I will let them self-correct and self-adjust to sell different strategies than other strategies. And if the market goes down, they'll self-correct and sell other strategies versus others because I just want to be continuously working towards neutral. So again, so go circling back around real quick. So if you sell a put spread and you're bullish on a stock, but as soon as you sell that put spread, the stock tanks, right? The natural inclination, which usually happens, right?
That's what happens to everybody.
Most traders, right? Really good analysis, get the position, 15 minutes later, it's down. So
Perfect.
so now your position is challenged, right? And so if you say like if you don't agree with the idea of trying to work towards neutral, then what you might do is you might sell another put spread, right? You might think to yourself, well, like if I liked it at 150, right, I'll love it at
Oh
50, right?
no.
Whole like and mentality. And then the stock continues to go down, right? So now you're in a position where you're digging yourself deeper and
Sure.
deeper and deeper into a hole. And the thing that really kills traders is running out of capital. Obviously, like if you run out of capital, you can't keep the lights on, but like digging yourself into a hole that's so deep that it's almost impossible to get out, right? We've all seen the charts of like if you lose 10%, you got to make 11, 12, 11% to get back to square one, whatever. It's like your goal is not to dig yourself into a insanely deep hole, right? And so if you're a trader and you have a bad sequence of trades, which is going to happen to everybody, where the market's just going to be irrational, right? Yes, that's a good one. Do you have it on your blog? Yeah.
Yeah, that's
Yeah,
for that
perfect.
exact. It's that exact reason. Yeah.
Loss recovery. Right. Exactly. Yeah. Like a 30% drawdown is, yeah, like that's tough, but like manageable. You lose 60, 70%, like good luck. You're going to be climbing that road again for another couple of years. And I just think people give up at that point. So if you do that trade and then you do another trade, and let's say you even do a third trade and you're like, there's no way the market's going down. It's like, I can't even handle it. And then you start praying and then you start like, doing seances and you start like rubbing
Yes. You
things that
get
are
the
like
sage
fucking.
out. Yeah. Yeah.
Right.
Yeah.
You start doing everything, right? And you start doing that. And then, of course, the stock continues to go to now you have this massive losing streak and you have this massive drawdown. So the alternative view is to do things that are generally opposing to where the normal portfolio is balanced. So if your portfolio is from the initial position is bullish, right? Like that's your initial position. Then the market goes down. Well, like why not add a call spread? Now it's not going to change the fact that you'll probably lose on the put spread. But like, don't dig yourself deeper into a hole. So like now, if you had a call spread and say convert it to an iron condor to use very like a simple idea, now you've given yourself an opportunity, not necessarily to like recover everything, though maybe you can, but now you're just not going to dig yourself into a hole. Like you're going to kind of work with where the market goes. So the market goes down again, right? Another leg down. Well, your call spread made money. Your put spread lost the same amount of money you were going to lose anyway. Now you sell another call spread, right? And the market goes down again, right? And now you have two call spreads that made money, and those might have overcome the loss from the put spread. At least you're back to square one, right? So the idea is like, don't get yourself into a bad sequence of trades by just trading one directional. If you can get to a level where you're working towards neutral, that doesn't mean you have to be perfectly, like, it's impossible to be delta zero. Like, it's impossible because the markets move too fast. Like, if you're delta zero, you're delta zero for a fraction of a second, then the market moves. And so if you're working towards neutral, that's just having an understanding of like, I have a crap ton of bullish positions. Like, even though maybe I really, really like the market, like, the smart thing is to maybe get some bearish positions or remove some of those bullish positions. So
Interesting. Yeah. So it sounds almost like you're using like a beta weighted deltas to then assess overall portfolio disposition and then trying to offset slightly.
yeah, and so you can do that. So like, we can do that. You can do that inside of a bot. You can do that with positions. And so like, my bots are set up to look at the beta exposure of the collective of positions that the bot has. And then based on that beta exposure, like if I'm bearish or bullish, it will then add a position. And sometimes it'll add a neutral position. Like if it's not too far out of bounds, like if my beta exposure is not insanely bullish, not insanely bearish, okay, great. Grab a neutral, really wide, sweep position. But I just don't think people really think about that. And they find themselves dug into a hole where they have 6, 7, 8 losses in a row when the market turns and they got unlucky. And that's hard to recover from. So.
And the best part about that story is that as soon as they liquidate all of their losers, the
The market
market
goes down. Right. Yeah. Of
immediately.
course.
Yes. Yep. Good. Yeah. That sounds exact.
Yeah. Chipotle. That's why I don't even eat their burritos anymore. It scarred me for life.
It's so funny to me how universal some of these experiences are.
You have to go through it. Like, you have
Yeah.
to go. That's why do feel bad for people who are trading right now, in the sense that like there's an overwhelming sense of like like this completely risk averse universe. Like VIX was back under 12 today, right?
Yep.
And people, I just feel like, are insanely levered to one direction. And it
Mm.
looked like the perfect opportunity. Like, I can see like some stats of like what people are doing because they share bots and templates and stuff. But like, I don't know. I get this feeling like people are saying, like, I had a buddy text me about a penny stock, and I'm like, oh my God, we got to be
Here
close
we
to,
go.
yeah, like, like, and he's like, nah, they say it's going to like $6. And I'm like, oh, we're close. Like, it's,
I always love it when the good old they say. Love it when
yeah.
they say.
Yeah, he literally texted me last week. He's, good friend, like family friend of ours. Like, and I don't think he understands options or markets or whatever. And so if he's thinking about penny stocks, like, we got to be close. So
That's awesome. Yeah. Well, I mean, it's really interesting just to hear the way you think about like broader portfolio theory, because it sounds like I always consider myself risk averse, but it actually sounds like you might be slightly more risk averse than I am. Is your kind of long, because, and to be clear, I typically maintain a relatively light book, but I have a moderate compound annual growth rate. So from 2007 to 2023, I just ticked over a 26% compound annual growth rate. So it's solid and consistent, but it's not like US investing championship level where I'm returning 300%. But my approach has been, it sounds like a little more risk open though than your approach might be. Because from my experience, if you have positions that offset too much, then
yes.
we've taken away our profit potential. So do you tend to set like a threshold where you're like, if I have X number of beta weighted deltas or just overall deltas, I want to maintain a short flow of a percentage of that kind of like that kind of
Yeah, I
thing?
think that's the challenge. And that, to be honest, like, that was a challenge, and still to some degree is a challenge to a little bit with like bots, because bots can't do that to that certain, like, that level of degree. Like, we can calculate like a beta exposure, but like, we don't know unless you look at them and you're like monitoring them, if like you just added a position that maybe offset exactly another position, right?
I see.
How you're like stomping on toes. So like, we have some technology that's like avoid like leg stomping and identical positions or inverse positions and stuff. But there's a certain degree of like, yeah, you don't want to just, sell $1 and buy $1 in the same thing. Like, you just wasted a bunch of time and effort and money. So I think that for me, like my range is like a 1% beta exposure on like a 30-day basis. So if I get like 1% out of bounds, but that's just for me, like where the market goes up and I lose 1% in 30 days, like that's too far one directional. So if I'm inside that range,
I see.
that's enough exposure for me. Like, but other people are insanely, they're like 5, 10, 15. Like people have huge swings, and like I've never been able to stomach that ever. Like again, like my childhood was like wild swings and volatility from my parents and their finances. There's no way I want to have that now. So
It's funny you say that, because that's actually a big part of why I consider, at least the way that I trade, also to be pretty risk averse, because I grew up poor and I had a single mom that I'm actually taking care of now. So I always view like the growth of capital is quite literally like a livelihood necessity. So it's interesting that you mentioned that, because slightly different genesis, but a similar output, where I'm not looking for a 40% portfolio swing at this. I think that I definitely have a little bit more of caution to the downside, not in terms of downside movement. I actually make some of my best years during
yeah,
bear
of course.
markets.
Yeah.
But yeah, but definitely portfolio variance. So interesting. We're coming up on time here. You have a game that you have to get over to, but I have to ask, when you look over the next, call it 3 to 5 years of options markets, we've both seen a bit of an evolution so far, right? So we've gone from standard expirations to weeklies to dailies to zero DTEs. That's moved over now to IWM. Like, we're seeing this progression of options markets. When you look out over the next, again, 3 to 5 years, something like that, what are some of the things that you expect to happen within the industry?
I think that what you're seeing is you're seeing latency collapse, right? So like that's been a trend that's like continued where like things are priced so fast, right? And now you have this like this trend with AI where it's not that AI is trading necessarily, but it's like what AI is doing to things that get traded. So what was it a couple months ago that Lyft came out and there was a typo in their thing and the stock was up crazy from a typo, right? And you got to think like something read that and then made a decision. And so that trend I think will accelerate where you're going to get like latency is almost zero. Like, so there's no room for a human to decipher things to a certain degree. So like, what does that world look like now where like, as a trader, there's zero latency between information and like market movement, right? That looks like a really volatile world where people are moving in and out of securities very fast. Again, like I said, like if you wanted to 20 years ago, like move capital, like it probably took a little bit of time. Even now, it probably takes some time. Like if you want to move brokerage accounts, like that takes time. If you want to get out of positions, you got T+3 settlement, like whatever, that's going to collapse. And like, so when you're going to see is you're going to see people moving in and out of things faster, which means things are going to be way more volatile, probably than they've ever been, right? Like we're going to get to a period where things are really volatile. And so in that world, you have to be like either A, sitting there waiting for it, or have something that sits there and waits for it and watches it for you because there's no latency and capital is moving faster. And I do think that we will get to a place where we get a 24-hour options market. And that should be insanely scary for a lot of traders because imagine how quickly an entire market can get pushed in the middle of the night. I mean, like, look at GME. Like, GME, somebody came back on Twitter and GME was up, right? Like, imagine what a real conglomerate of funds or bad actors or whatever, good actors or just people could do to a security overnight while you're sleeping as the market's trading. And you get a margin call notice in the middle of the night and you have to fund it by 9 a.m. and you don't even know because you slept in and now they liquidate at the worst possible price and you're gone. Like that world, I believe is coming. Like I think it's going to be 24 hours, 24/7, 24/5 markets for options trading. And that's a world that if you're not prepared for that, I think there's going to be some bad stories. So.
It's interesting. I definitely see parts of that. I think some of the counterpoint I would offer is we already have futures that trade most of the time, and we're not necessarily seeing that kind of volatility, but they're also way larger, way more liquid. So smaller individual stocks that might be trading like that, I can absolutely see that happening too. So we'll have to see if it comes to
But at the
fruition.
same time, like, like that time when like crude oil went negative, right? Like a physical crude oil went negative and you were getting paid to take crude oil because it was so crazy. Like no one ever thought that was going to happen. And so
Mm,
like that kind of stuff, if that happens, it could wipe out an entire generation of traders. And so that's what I guess I'm like, it's very interesting to have 24-hour markets. But I think as we go and as markets start to evolve and become faster and things get read by AI and then they get traded, like that's a really different world, you know? And I don't know if people
Well,
are.
yeah,
Yeah.
and I mean, I especially agree with the trading time frames and windows. Like that does add a certain level of risk and complexity. But I actually think your other point highlighting the integration of AI. Again, it's such a buzzword now. I almost hate saying it, but it is a thing, man. And it like you're talking
It's
about,
stupid. It's
yeah,
stupid in the sense it's not like I agree it's a thing, and but like one of our guys on our team is like wicked smart, Rob. He's like the smartest human I know, honestly. And he put it the best way to me. He's like, AI is stupid because all it's really doing right now is it's trying to predict the next word in a series of strings of words. And that's it. Like it's not
right.
like so you could trick it to do anything you want to a certain degree by priming it. And so but it will get better, right? Like it'll start to figure out these things. But if it can misread a 10Q, like then we've got problems first. So
Yeah, man. Well, I gotta say, dude, absolutely awesome to meet you. A blast chatting. I'll obviously throw a link to your website in the description below, but is there anywhere else that you want people to be aware of to go check out?
no, you can just check me out at Option Alpha. No, it's super fun, man. I appreciate it. Love talking to traders and guys that like cars. I feel like we need our own special place, you know.
Yeah, man. Well, brother, absolute blast. Time for you to run, but thanks everybody for hanging out, and then we'll see you guys on the next one.